And European currencies begin to perform as expected, which is to say, they begin to fall against the US dollar after their resilience in the face of US dollar strength over the past 2 weeks. But the move is far from over. Yesterday, the pain was in the UK. Today, it might well be in the Eurozone. This is what we're going to tackle here today on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we'll review here a little bit what's been going on with the greenback and consider what comes next as we focus here on the next part of this story. We, of course, have seen that the dollar has had its best 2 weeks as of the close of last week's trade since February 2023, and the advance continues. What we noted yesterday, and we'll link that up top here if you're watching this back on YouTube, was that European currencies did meaningfully better than did their Asia-Pacific counterparts against the dollar as it was rallying. So the yen fell the most. The Australian dollar was also quite weak, but the losses in the euro and the pound were much more limited. Each one of them was down just 1.6% relative to the dollar over those 2 weeks, whereas the Aussie lost in excess of 2.5%. The yen lost in excess of 3.5%. And that seemed to be because there was a little bit of a positive shift in policy expectations for the UK and the Eurozone in the same period. So there was a bit of insulation for the pound and the euro as the dollar rallied. That defense started to break down as expected with the UK overnight. They released some weak CPI data. We discussed it at length on the show yesterday, why that data was likely to miss and what it would do to the pound if it did. And in fact, that's exactly what we saw. The data missed. Expectations for Bank of England rate cuts expanded, and the pound tumbled. We are now looking today at a 67 basis points or 0.67% of a decline in the pound against the dollar, which would give us the biggest sell-off in 2 weeks, as a matter of fact. Now, this spotlight is going to turn, and it turns to a policy announcement from the European Central Bank. The expectations here are narrowly for another rate cut. So if we take a look here, we can see we're baking in October at 3.36 as relative to the current deposit rate of 3.5. So if the cut was fully baked in, that would be 3.25. It's a little bit less than that, needless to say. And so the cut is not fully accounted for here, but we are narrowly leaning in the cut's favor to the tune of about 56% or so. And so as we look at this then, the question becomes, okay, maybe the cut happens, the market is tilting in its favor, but it's close to 50-50. If it occurs, that's probably room for the euro to adjust lower. Because, of course, it's not like we're sitting at 80% chance of a cut, 90% chance of a cut. There's lots of room here for a significant contingent of market participants to have to reprice if there is the cut. Now, looking out to December, we can see the cut is already there. So obviously we're below 3.25 here, but not quite all the way to 3. So the likelihood that we get another cut in December, not altogether full, but likelier than not. And if we take all of this in tandem here, not only this, but where we're going in the following year, we see that through the rest of this year, we're baking in 44 basis points in easing, so not quite 2 cuts, but leaning there. And then next year, about another 4, so just over 100 basis points right here for a cumulative 147 basis points, or basically 1.5% in cuts between now and the end of 2025. Now, the likelihood that we get both of these cuts from the ECB, when you take the whole thing together, the next 2 meetings in total, then you're left with an 88% chance that they both occur. So there's some fuzz around how they occur, but needless to say, if there's an 88% chance that they both occur, it's quite likely. And with only 2 meetings left, the easiest path forward is a 25 basis point cut at each meeting. So it seems relatively baseline, with some room for surprise, that if the ECB cuts this time, as long as they don't then change their rhetoric to something meaningfully hawkish or more hawkish, then the market is about where it needs to be, with a little bit of room for a dovish adjustment if it occurs. What's interesting here is that the bias, frankly, isn't more dovish. And this is where that resilience of the euro, much as the pound before it, really starts to be reflected in this somewhat more modest view of rate cuts emerging over the recent weeks. Notice here, just in the past 6 weeks or so, we've gone from 179 basis points to now 147. And some of this is the unwinding of the crescendo for global equity markets, where things got sold off very hard at the start of September. But nevertheless, it's been a bit of a shift here, and indeed we can see it in the overall curve as well. Things start to kind of flatten out here a little bit. Things are a little bit more dovish relative to when the ECB met in September, but not very much. And that seems to clash with what is a meaningful economic divergence. So consider 147 basis points for the Eurozone here expected, and 134 basis points as of today for the Fed. That's about 30 basis points left for this year. So a slight chance for 50 basis points further in easing. That's maybe a little bit of an understatement. The Fed seems to be relatively locked in for cuts over its next 2 meetings. There might need to be a reshuffling here over time from the outlook for those 2 cuts for this year looking more certain, and next year's tally coming in a bit. But as it stands, 134 basis points and 147 basis points are not far apart. That's a difference of less than 1 cut. That's only about 13 basis points. Meanwhile, the economic divergence between these economies is acute. Consider, looking at September, Eurozone's economy shrank again. This is according to Purchasing Manager Index, or PMI data from S&P Global. We can see here, as ever, this set of indexes oscillates around 50. 50 is neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Late last year, there was a shallow recession or recession-like situation in the Eurozone where services and manufacturing were contracting at the same time. That is, they were under 50. And so, not surprisingly, the composite that takes them together was in contraction mode. And we saw that basically from mid-year through the end and going into the beginning of 2024, the Eurozone economy was shrinking. Services then powered a rebound that crested early in the year and has since been unwinding, such that as of September, services was near standstill at 50.5. The situation in manufacturing continued to deteriorate, and so the overall slipped back into contraction mode for the first time since the beginning of the year. Compare that with what's going on in the US, where, yes, there is also anemic manufacturing, but the service sector has held up remarkably well. In May, we hit what was a 12-month high on overall composite growth relative to May of 2023. We have since idled there. So it is not as if we are looking at a situation where things are accelerating, but they are certainly not decelerating, and they are holding up at the high for the trend that's emerged essentially since the beginning of 2023 in the wake of the Fed's rate cut cycle, essentially running most of the tightening that there was to do. And so, needless to say, it seems a bit odd that you have less than a 25 basis point difference in rate cut expectations, while at the same time the U.S. economy is doing dramatically better than is the economy in Europe. Consider even just the flow of economic data. So here's the zero line on the City Surprise Index. Above zero, data is tending to beat relative to forecasts. Below zero, it's tending to disappoint. Notice, since about mid-March, early April, both of these economies were deteriorating until in late August going into September, they diverged. And the U.S. economy started to rapidly heat up, where at this point, we're looking at data that is tending to outperform. We're above zero. It's tending to beat forecasts, whereas the situation in Europe is much more circumspect. We're at best idling. And we're idling below zero, which is to say we are tending to miss relative to baseline forecasts, which of course suggests that economists' models of the Eurozone economy are still more optimistic than reality endorses. That, of course, implies that the markets have a larger adjustment to make. A case in point, of course, the latest numbers for Eurozone inflation, 1.8%. That's the lowest since early 2021. We can see that with the naked eye here, having been as high as 10.6%, much higher than what we saw in the US. And that was, of course, lower than expected. The expectation was 1.9%. Moreover, if we look at where inflation lives, much as we saw with the UK, most of it is stuck in categories that are very sensitive to discretionary spending, mainly hospitality. Now, as we get out of the summer vacation season, and indeed as we consider how sensitive this kind of a sector is to discretionary spending, stands to reason that if we're looking at an abysmal situation on growth, such as we apparently are in the Eurozone, then discretionary spending intent will diminish. The seasonal sort of summer hospitality spend forces will recede as they do every year. And you're going to be left with the stickiest part of Eurozone inflation unraveling. And if you're the ECB and you're then looking at these numbers here and saying, well, is this a flash in the pan downtick or is this sustainable? This starts to look much more of a durable decline. Now, if you're on the fence about whether you're cutting or whether the ECB is cutting, such that the markets are only baking that in, as we saw over here with a 56% chance, and there's very little daylight between the expectations that we have for the Eurozone and the US. Meanwhile, in the Eurozone, you have inflation that's at this point basically at or below target. You likewise have the things keeping it from being even lower, vulnerable to unraveling because of the dire economic circumstances. It seems somewhat of a close reach to say that the ECB has room to recalibrate expectations to a more dovish setting. If the Fed is priced about right, and there's not any major U.S. economic data on the calendar to suggest otherwise this week, then the adjustment, at least near term, is with the euro and the ECB. So if they deliver this cut, you get perhaps a little bit of downside there. But really, it is in the rhetoric, in particular from ECB President Christine Lagarde at the presser after the policy announcement, that you might discern a dovish escalation in policy intent. And that is something that's likely to weigh heavily on the euro if it transpires as that yield differential gap widens. Again, if the outlook for the US is about right, maybe you need to reshuffle some from 2024 to 2025 or the other way around. But if that 130 odd basis points looks about right, and we take that as given, then there certainly seems to be room for at least some certainty for the ECB to say, well, it's not a 44 basis points for this year, it's 50. And maybe next year it's a bit more yet. Now, we already see the euro starting to break down. There's a support cluster here on 6E futures just around the 109 figure. We're testing through that now. The next meaningful inflection point seems to be down to the 108 figure. We can see that was something of a point of friction, first as support, then as resistance, then as support again. So that seems like the next line in the sand. And underneath that comes the 107 figure. We can see that's touching these lows here. And then, of course, the year-to-date bottom. And that's all the way at 106.30. Ostensibly, you would need to retake all of the ground here and reclaim a foothold above 110 at this point to really diffuse the immediate selling pressure that's on the table. Now, perhaps the ECB surprises. Perhaps they don't quite deliver as much of a dovish message as markets expect. And the euro then manages to find support. But the path of least resistance seems to point elsewhere. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where it may lead going forward. Back on with Chris for Futures Power Hour on Friday. I'll be on, as I am every Wednesday, with Victor Jones for The Price of Truth. That's coming up just 30 minutes after this show here concludes. We'll be on for a full 90-minute discussion, freewheeling as it always is, about markets and geopolitics and all the various things that might be shaping price action across financial markets. I'll be back on with Victor for First Call on Sundays with Tom, just at the market open, writing for the news and insights portion of tastylive.com, commenting on the platform formerly known as Twitter at Ilya Spivak. If you're watching this on YouTube, like and subscribe, and Macro Money will be back with you tomorrow.